Chapter 10, Capital Markets and Pricing Risk. So in this chapter, we're going to cover 8 different topics. What are those 8 topics? So the first one is we will go into what is risk, and then how do we measure the risk. And there are 3 different measures: volatility, standard deviation, variance, and standard error. So once we know what is risk, we look at how to measure risk. And then we look at 2 different types of risks: common, systemic, or market risk, and second, independent and company specific risks. So once we cover different types of risks, we will look at what is the relationship of risk and return, and look at how returns in portfolio can be optimized. And then we look at diversification, which helps us in removing independent risks. And we will finally look at the last 2 topics, which is beta, which is measure of systemic risk. We looked at 2 different types of risks. Systemic risk you can measure through beta. And finally end with cost of capital, which is basically this CAPM, capital asset pricing model, which allows us to calculate cost of capital. So these are the 8 topics for chapter 10. So let's look at each one of them in detail. So what is risk? So when you invest in stocks and bonds, you expose yourself to volatility. So this volatility is where the stock goes up and down. So its performance can be up or it can be down. So when you invest $100, it can become $120 or it can become $50. So if you want that $100 back when it has become $50, you end up losing your investment, $50. So the fact that you can lose money, either partially or fully, that's the risk that you take on, because the performance is volatile. So the possibility of losing money is the risk, and that is equal to the volatility of the stock. So that is risk. Risk equals volatility. And typically stocks outperform bonds over a long period of time. And by long, read 10 plus years, right? Because there have been cases where stocks have not performed better than bonds for even 5 straight years. So if you were to look at risk return, then if this is how the stock is performing, then we can see that the stock is performing. It has lots of volatility, goes up and down. But the bond will probably go up with a lower slope. So at any point, even if you'd invested here, you would have been worse off because the stock would have performed lower for 5 years. But if you'd have held it on more, that the stock would have performed better than the bond. So that is risk. And we looked at how it's important to invest for the long run, but understand that volatility is what drives risk, because you might want your money back when the market is down, and that's the risk that you take on. So what are the common measures of risk? Expected return is basically how much money can you expect to gain from this investment. So it's the summation of probability distribution of a given return. So if 20% of the time, let's take an example that you get 10% return, and 50% of the time you get 0% return, and 30% time you get minus 2% return, then expected return is basically the summation of the product of probability and the return that you expect, right? So if you do that, you will get an expected return to be like 1.4% for this probability distribution. So once you can measure expected return, you can calculate variance. So from variance, you can calculate standard deviation, which is volatility. So how do you calculate variance? You calculate variance by summing up probability multiplied by the return you get for that probability distribution minus the expected return squared. So when you do that, you get variance. And if you take the square root of variance, you get standard deviation. So this gives you from expected return. So first you need probability distribution, From probability distribution, you can create expected return. From expected return, you can create variance. From variance, you create standard deviation, which is same as volatility. And as we saw, volatility equals risk. So this is a risk measure. Standard deviation of a stock or a portfolio is a risk measure. There's a alternate way of calculating volatility. You can calculate it by average annual return. So if you have return over t periods of time, you just calculate the average. When you calculate the average, you get the average realized return. From the average realized return, you can create variance by summing up the return over time t minus the annual average return squared divided by 1 over t. So this is another way in which you can create variance, and from variance you can create standard deviation, which is volatility. So we saw previously how we can do it from expected return if you have probability distribution, or you can do it from average annual return. If you do it from average annual return, it's an estimate of the true expected return. Expected return is the most accurate way, but if you do it from the average, then you have to calculate standard error. And because the standard error will tell you like by what margin is your estimate correct and not correct. So for example, and there are two other conditions, that the samples are independent and they're identical. When you do that, you can create standard error by doing standard deviation divided by square root of number of periods. So when you do that, you get standard error. So you can say, hey, if you go back and calculate expected return, then that's the best way. You don't need standard error. But if you use average annual return, then you have to use standard error to say, hey, if I expect 4%, so in this case you could say, in this case you would have to say, let's say I expect 4% return plus and minus standard error, right? So standard error, let's say it's 1%, then you can say my expected return would be 4% plus and minus 1%, which is 3 to 5% is the range. But you don't need to do that for expected return. So we realized how we can calculate volatility, which is the measure of risk, which is standard deviation. And we found out two ways. In a sense though, there is realized return is equal to the dividend yield return plus capital gain yield return. So that's the realized return for any given portfolio. So now we saw two different ways in which we can measure risk. We can measure it through standard deviation, which we can calculate from expected return, and we can calculate from average return. And you can calculate expected return if you have the probability distribution. All right, so let's go to the next topic. What are the types of risks? There's only two types. One is common, systemic, or market risk, which these are all different terms used for the same. A common risk or a systemic risk or a market risk is a risk that impacts everyone, right? For example, if there's an oil price hike, then it impacts everyone, because if it's the raw material, then every company will be equally impacted. If, let's say, the interest rate goes up, that's a systemic risk or a common risk or a market risk. Or if there's a labor market issue, then these are all the same terms for the same type of risk, which is undiversifiable risk. This is the risk that you can't get rid of, right? Common risk, systemic risk, market risk, or undiversifiable risk. There are four ways of saying the same thing. And the second type of risk is independent risk or a company-specific risk. Let's say a company does well and they have a really good product launch. Then that's a company's specific positive risk. You actually got a positive return. But the same company could perform really poorly. Then you have a company-specific independent risk or idiosyncratic risk or a unique risk. These are all four different ways of saying the same thing. This is a risk that is diversifiable, which you can get rid of. So this you can get rid of, this you can't get rid of. So there are two types of risk. And returns in a portfolio is an important area, because we'll get to how we can get rid of independent risk and how we are rewarded only for systemic risk, but not for independent risk, because we can get rid of independent risk. So next topic is returns in portfolio. So if you look at historical data, it looks like there's higher volatility in certain stocks like small caps and medium caps. They give high return, but that's not true. High volatility does not equal high return. You could have a large portfolio like S&P 500 and it has low volatility but high return. But at the same time, you could have a large stock that you could have one stock position, you have high volatility and high return. But any individual stock might have a higher volatility and lower return. So high volatility or high risk is not equals high return. So let's look at this example from this chart. So risk return trade-off, right? So in this, we are seeing on the x-axis volatility and on the y-axis historical average return. So we see here very clearly S&P 500, the volatility is much lower compared to all of these individual stocks that are in yellow, and the return is actually better than all of these companies, right? So why is it that this line is not something like this, right? Because these are the individual stocks, but it's actually this, right? Performance is this. So that's a puzzle that we can now solve if we understand independent risk, right? If we create an efficient portfolio, then we can reduce volatility from this area to this area, but we can keep the return high. So an S&P 500 basically is an efficient portfolio. It's a portfolio where if a certain company does well, it also combines a certain company that doesn't do well, so it averages out. And that's why it has lower volatility. Some company can do well, some company might not do well, and vice versa. In period 1 this does well, in period 1 this doesn't do well, but at the same time in second period this can go up and this can go down. And so overall you can reduce volatility if you have a market portfolio, and you can have lower risk and higher return. So that's the reason why this line goes from here and not through here, right? All right, so that was the question that was here, which was S&P market portfolio has lower volatility. It's a combination of individual stocks, because we saw that S&P 500, it has removed all of the diversifiable risk components. So diversifiable risk is equal to 0, and it only has the undiversifiable risk, and so it can have lower volatility and high return, right? So that's the reason why this black line is this way and not going through the center, right? Cool. So primary reason again was that it has 0 diversifiable risk. It has only undiversifiable risk in S&P portfolio. That's why you get higher return and lower volatility. Another myth is that long holding periods equals low risks. That's not true. Imagine if you were retiring in 2006 versus when you retired in 2008. 2008 is a longer holding period than 2006, but your portfolio would have been 2x more in 2006 versus 2008 because there was a big recession in 2008. So long holding period doesn't mean low risk. Okay, now let's recap how we can remove the diversifiable risks, which will again explain why is this black line going this way and not this red line, right? So all of these portfolios, as you can imagine, S&P 500, World Portfolio, mid cap, small cap, these are a collection of stocks, right? So these are a collection of portfolios which have removed their diversification risk. Because if you create a portfolio, you can assume that it averages out. Performance averages out. So if a company A, as I said earlier, faces a company-specific risk and doesn't launch a product that was good, but at the same time, in that same portfolio, you could have company B that does really well. So if you add both of them up, it averages out to 0, right? And sometimes you could have more companies doing better than fewer companies. So compensation happens of A's based on B's performance, and the portfolio overall goes up. And the key insight here to take is that market does not reward you for holding diversifiable risk, because it can assume that you can do diversification like by creating an efficient portfolio. But if you don't, then you don't get compensated for holding on diversifiable risk. And beta is basically a way to measure systemic risk, right? We saw how there are two types of risks: diversifiable risk and undiversifiable risk. So beta is what helps you to create and measure undiversifiable risk, a risk that you cannot get rid of because it's something that's outside your control: oil price hike, interest rate hike, poor economy, something that impacts everyone. So an efficient portfolio only contains systemic risk, and it doesn't, and you cannot use diversification further to reduce risk. The only way you can reduce risk is by reducing return. So an efficient portfolio contains only systemic risk, no diversifiable risk or independent risk. And a market portfolio like S&P 500 contains stocks from like all the companies equivalent, and so it's an efficient portfolio. So market portfolio is an efficient portfolio. That means it has zero diversifiable risk. It only has systemic risk. So in a sense, if you were to summarize what beta is, beta of a security is the sensitivity of the security's return to the return of the overall market. So for example, if a market moves by 1%, and if beta of Johnson & Johnson is 0.2, that means that Johnson & Johnson will move by 0.2% because of the systemic risk. So if a market has a systemic risk of 1% movement, then Johnson & Johnson only has 0.2. So it's better. Lower beta is better, right? So how do we use beta to calculate cost of capital? Cost of capital, first, in intuitive sense, is basically what return or what yield is the shareholder expecting from this investment based on the current company, right? What would they expect? That's the cost of capital to invest in your company. So cost of capital, RI, it's a rate that is expected from this investment I, is risk-free rate plus beta of the company times expected return of the market minus risk-free rate. It's basically saying I want the risk-free rate return plus beta multiplied by the market premium. So this is market premium, right? Expected market return minus risk-free rate. So basically, let's take an example again. If eBay has a beta of 1.4 and Johnson & Johnson has a beta of 0.2, what is the cost of capital for eBay and what's the cost of capital for Johnson & Johnson, assuming risk-free rate of 5%, like meaning you can have T-bonds or treasury bills at 5% and overall market portfolio returns 11%. So using this formula, RI equals RF plus beta multiplied by expected return on market minus RF, we can actually get that very easily. So this is risk-free rate, 1.4 is beta, 11 minus 5, which is market rate, minus risk-free rate. It tells you that eBay has a cost of capital of 13.9%. Similarly, with a beta of 0.2, Johnson & Johnson has a risk-free rate of 5% as well. It has cost of capital of 6.2%. That means the market expects eBay for investment I to generate 14% return, but only expects 6.2% from Johnson & Johnson. So basically, it's cheaper to fund investments in Johnson & Johnson. It has a lower bar, lower threshold versus eBay, which needs to generate higher return. So lower beta helps reducing cost of capital, which basically says there's a lower return expectation because the risk is low, right? Higher the beta, higher the risk, higher the return expectation. So basically, eBay needs to give its shareholders 13.9% for investment I. For the same investment, Johnson & Johnson only needs to give 6.2%. Higher beta, higher risk, higher cost of capital. So beta measures sensitivity of markets to systemic risk. So if there's a systemic risk in the market, and we assume that market portfolio has zero diversifiable risk or independent risk and only has systemic risk, then if 1% movement of market happens, then beta measures how volatile that company is to the systemic risk. So again, there's this other myth, beta equals volatility. No, beta is not equals volatility, because volatility risk includes two types of risk, as we saw earlier, systemic risk and independent risk. Beta only measures systemic risk. So for a market portfolio, if let's say this is the market portfolio, and on the left we have efficient portfolio performance, which is, let's say, S&P 500, right? Because that's an efficient portfolio, it's a market portfolio. And here is the overall market performance. So if the market performance goes this way, and if your portfolio goes in this curve, then alpha is basically when the market returns 0%, what is your portfolio's performance? If your portfolio performs 2%, that means when the market returns 0%, your portfolio gives a 2%. So higher the alpha, the better, right? And given that this is an efficient market, this variation, this movement, it's the beta of the portfolio, right? So beta is basically how much does it deviate, how volatile it is compared to the market. So if the market returns is this way, if it's volatile, higher the volatility, higher the risk. But remember this, that volatility, beta equals volatility only when you're comparing it with an efficient portfolio or an independent, which has zero independent risk. So beta equals volatility, alpha equals like when the stock market returns zero, what is your portfolio's performance? So hopefully that is helpful. If you have any questions, put them in the comments. And this was very helpful for me as well to revise this chapter. Thanks.